Good evening. This is Ken Long from Tortoise Capital with a review of the daily trading plan for April 9th, 2011. We're in bullish normal conditions on an annual basis and on a 10-day basis. We are slightly above average in the channel. The percent stretch above the 200-day moving average at 11.26 is still bullish, but it's pulled back from the green zone into the white zone, so slightly above average. The slope of the 50-day moving average is at 0.35, and that's bearish because that's as weak as it's been in the last 180 days. That's why it's coded red. ADX at 14.7 is on the weak end of a trend, or it's untrending. That's a position from which the next trend, whether it be up or down, can have a 3 to 5 week move in SPY. ATR percentage dropped below 1 to 0.85%, back into the low range of normal. On the 30-day gap stat, we have 14 times out of 30 the market is gapped down. 8 of those times it's reversed to close up with a 0.57% follow through. 6 times it's gapped down and failed further, also for 0.57 follow through on the negative side. It's gapped up 16 times in the last 30. 10 times the gap up has reversed and closed lower with a follow through of minus 0.64%. When it is gapped up and continued to go up, 6 out of 30 times the follow through has been 0.38%. You can see on a 10-day index time series that we pulled back from overbought conditions. The intraday range stat for SPY, 1.68%. That's the maximum normal average move we can expect. No signals in overreaction or channeling system. You can see the daily pivots. SPY volatility, you can see it's pulled back almost 3 standard deviations from the high end about 2 weeks ago, and we're approaching bull quiet once more if we can get below the red line. ADX, you can see, has pulled well under 15 now, and plus DI and minus DI are equal to each other, and that's about as sideways a market as you can possibly get with an ADX reading. When the market's in that kind of non-trending condition and poised to go in either direction, we're going to shorten up our time frame, and you can see the 10-day min pain and max pain. On the max pain, my favorites, looking at Hewlett Packard, Cisco, and Intel from the technology sector, Disney and Caterpillar rounding it out from the Dow 30. On the 10-day max pain for the ETF 100 most liquid, natural gas, the VIX, Japan, transportation, and agriculture. Very few pattern trades in effect. Natural gas is one of them on a 551W, and you can see the from the elder safe zone category, those symbols that got measurably stronger or measurably weaker, depending on Friday's price action. Taking a look at the Dow summary, the tactical summary. Very few patterns. The only pattern we have is channeling in Disney, which is also the third, number 3 in the priority for max pain range compression. The others being Johnson & Johnson, Intel, Disney, Boeing, and Caterpillar. Only a few dojis inside the Dow 30. Taking a look at the ETF 30 tactical summary. Only 2 dojis, treasuries and natural gas. Natural gas is the number 1 max pain range compression. It's also a 551W, and that's one that's worth looking at. Percent winners on Friday, the VIX, Japan, and silver. You can see silver has resumed its dominant price action. Taking a look at the supplementals, the slope of the regression line is up. However, it's been price action has been halted at 134. That is acting as a strong resistance. It's made a 2 standard deviation move since crossing over its 10-day moving average. That was a price move from down around 130, and seems to be stalling out right now around average. The percent stretch above the 200-day, you can see it's below the first green line. That makes it between 0 and 1 standard deviation. That's why it's coded white at about 11.8%. Just quick references on the range stats for you and the gap statistics. And you can see the sideways action here the last few days has kept the safe zone channel bracketing the price action. On the quality report for the Dow, again, what I am looking for is something that was red 2 months ago, but which is yellow or white now. So I like Walmart, Johnson & Johnson, and Microsoft. Excuse me. Merck has already pulled ahead. It's bounced out of the red zone back up into the green. There may be a candidate for follow through here. It's been red, white, red, and now green. That could be the start of a nice bounce in Merck. Taking a look at the ETF 30 or quality reports. Again, I'm looking for red followed by yellow, and that makes me interested in natural gas. I could see Brazil going from red to white conditions. So in white, that means in the last month it's been above average with a quality score of 2.11. So Brazil is a continued stalking target for me. By the same token, emerging markets, we'll see that we'll see emerging markets are the number 1 or 2 in terms of strength for the ETF2 database. So going from red to green, emerging markets have bounced up nicely. The percent winners from Friday: oil, Japan, blended commodities, and silver. Percent losers: industrials, Russell small caps, and financial sector. A few more supplemental charts looking at the relative strength score for the various indexes. Mid caps have been giving up their strength, and the Dow has started to move ahead of the other U.S. indexes. That's where some recent strength has been. You can see the rebound in commodities lately, with DBC leading the way, almost a 2 standard deviation move up. That's as good as it's been over a 30-day basis, and so I see that as an alert to be prepared to preserve your gains in blended commodities. However, you can see that oil and gold are just back to parity. The zero line is the relative strength of SPY, and so they have just come back to parity now. So I still think there's room for both of those to go up, and by extension, silver. Looking at the internationals, you can see they've all bounced pretty nicely. Japan is starting to recover, but it looks like EFA has had a nice bounce over the last 30 days. The Elder Safe Zone, DBC and DBE were measurably stronger. U.S. small caps and Alcoa were measurably weaker. Just a quick review of the top winners over the last 10 days and then 30 days, top winners and losers and their follow-through from Friday. Quick reference on the daily pivots and weekly and monthly as well. Quick review of the holding X number of days. Yeah, the bounce of the last 10 days has been, although noticeable, has not really been extraordinary, as you can tell by the Z-scores. These are all well under 1.0, meaning that it was not an extreme 10-day move by any means. So there's reason to believe it can find support here and then power through 135 to make a new swing high. A quick look at the correlations between indexes and with respect to SPY. The 30-day correlation among major indexes is still fairly high. The index most out of correlation has been Japan. The tightest correlations with SPY have been the U.S. sectors, as you can see. and that's the a review of the daily trading plan. Not many patterns. I'm looking for continued follow through. I would stay with the strength leaders. I'm expecting some gains out of technology, however, because the NASDAQ has been lagging. If we're going to see any kind of strength in the U.S. to get it through 135 in SPY, then technology is going to have to catch up, and that's why I'm stocking that on as a value play. So that's Ken Long from Tortoise Capital. Good trading on Monday, and we'll see you in the chat room.